Hey traders, Leaf West. Another video in my series where I try to explain some of the trading tools, indicators that I use on a daily basis. This video I am doing now is on the squeeze indicator. And the squeeze indicator, for those of you that have seen my charts and my videos, is this colored band along the bottom of the price chart. It's gray when a squeeze is not on, and it's green when a squeeze is on. And I'll explain what goes into making this calculation in just a second, but the concept is that price goes through a series of contractions, periods of contractions and expansions. And after a contraction, expansion will happen. And expansion is the time in period where you want to be owning a stock or an ETF or what have you, because that's when price is moving, whether it be up or down, whether you're long or you're short. You want to be owning or shorting a security when an expansion period is happening. That's where price moves. That's where you make money. And I'll show you both intraday examples and longer term examples of the squeeze. But the concept is the same for both intraday trading and for swing trading, in that you want to look for stocks that are squeezing, contracting, and make a decision as to whether you think it's going to go higher or lower, and then hopefully get positioned before the squeeze is over. This chart is the 3-minute chart from Friday, August 17th, for Apple, and I've stripped away all of my indicators except for price and my colored candles. Again, go to the video on those to understand really what all these different colors mean, but we're going to concentrate on the squeeze indicator, which is this green and gray bar sort of chart along the bottom of the price component of the chart. So how do I calculate this? Well, really, what it does, what the calculation is a comparison between the Bollinger Bands and the Keltner channels. And lots of people have heard about Bollinger Bands, but not as many have heard about Keltner channels. And really, the only difference, both of them are create kind of envelopes around price as price goes on its merry way. The Bollinger Bands, which most people are aware of, are based on our standard deviation, and you can set it to whatever you want, but the standard, I think, is a 20 period analysis based on 2 standard deviations around that. And that's usually what the Bollinger Bands are. And so here is an example of the Bollinger Bands around price, right? And so lots of people have Bollinger Band trading strategies, and that they say, okay, well, when price breaks outside a Bollinger Band, I want to fade it. So when we broke above the Bollinger Band here, I'm going to sell for an assumption that price is going to move back into the Bollinger Bands. And then lots of people will look for when Bollinger Bands get tight, but you can have your Bollinger Bands up and track that for price, but for me, I have lots of other things up, and I really don't want to add to my clutter. So I created this idea of putting a squeeze indicator on the bottom, and had a guy write some code for me, and it works fine. So again, this is the Bollinger Band. This one is based on a 20 period 20 period analysis, and a multiple of a multiple off that, a standard deviation multiple of that. I don't use a standard 2.0. I use something else, but that's fine. You can use what you want. And then the Keltner channel is the same idea in that it measures price, the moving average of price, and it puts an envelope around that. But instead of using standard deviation, it uses the average true range of price, which is a little different. So there's subtle differences. And so if I put up the Keltner channels, again, the Keltner channels, the default is 20. I don't use that. And then you have a factor which you times it by that. So I use something that's slightly different, which gives me historically what I want to see in terms of a squeeze. So people can use what they want, but I have ratios that I use based on my experience. So I don't really want to tell people that because you should get comfortable with what you think works and what doesn't work. And I just want to warn people that this example of the Keltner channels, this eSignal calculates their Keltner channels a little differently than other people, and they won't tell you how they calculate it. So my squeeze indicator is based on the actual way that Keltner channels are done by most people. Now eSignal does theirs a little differently. So when I show you this, the examples won't line up perfectly, but I wanted just to show you what people can do in terms of, if you didn't have this bottom indicator, you could actually just have your Keltner channels up and your Bollinger bands up, and do the exact same thing that this does, except again, you're going to clutter your chart a bit more, and then you got to look and see, well, is that inside, for example, the easiest spot to see is right here. The blue Bollinger bands are both inside the Keltner channels. So that is the squeeze. That's what I'm looking for. That shows me that volatility is shrunk to a point where I would expect price to move after, once the expansion period starts. So again, we go from contraction to expansion. We go from contraction here to expansion. So again, let's just focus on this. So what I'm trying to do is find periods where the Bollinger Bands are inside the Keltner channels. That's the contraction period. And I've got it condensed into this indicator below, so I don't have to have these. So if I turn these off, right, you can see that I don't need to have those on zero. Is that in there? Are they both in there? What's going on? This does it automatically for me. And again, this does it based on the correct version, well, the normal version of how people calculate Keltner channels. And again, the eSignal calculates their Keltner channels a little differently, and they won't tell you how they calculate it exactly. So they don't line up perfectly. So, because if you look here, right here, where my cursor is right now, both the Bollinger Bands are inside the Keltner channels, but my calculation is not giving me that squeeze yet. So there's a slight difference in how eSignal does it on their and actually eSignal by itself doesn't have Keltner channels. The eSignal Get version has it, and that's what I have for my software package. So most people who have eSignal don't have Get, which is the more fancy, more sophisticated version of eSignal. So most people can't even have these Keltner channels up who have eSignal. You'd have to go with some software code that they write themselves or what have you. So that's the idea behind it. You look for periods of contraction, and then you want to get positioned for a period of expansion. So that works for intraday trading and works for swing trading as well. So let's just see how I would read this. For example, on Apple stock. Okay, so let's get rid of the Bollinger Bands. So let's just follow along with my squeeze indicator. So what do we have here? So you can't just say that this is bullish or this is bearish. You have to look at the evidence of price prior to being squeezed as to your most likely indicator of which way price is going to move. Hang on one sec, guys. All right, sorry about that. So here on Apple on Friday, we had a bullish gap higher, and then price went to make a new high, and actually it made an all-time high here. So price is bullish, right? And when price makes a new high intraday, we always want to look to buy pullbacks, right? So price pulled back and started to move higher, and then it started to squeeze. So your thought should be that after the squeeze, we should probably, hang on one second. All right, sorry about that. So that would be your first sort of bigger clues that we're expecting price to go higher. So when it gets into a squeeze here during a pullback, consolidation period, contraction period, that we should expect price to go higher coming out of that. So that's what you would expect. So when price breaks out of the squeeze, it does go higher, right? You can also use, when it's not so obvious that you're making new highs, then it gets a little more tricky. And generally what I like to do is look for, let's go back and look at another example. For example, say one early in the day, because squeezes happen usually, it can happen in the first hour, and those are usually really good squeezes to get involved in because then you get the expansion for the whole day. Squeezes later in the day move less, because most of the trading is complete for the day, and it's really in the early morning squeezes that you get the biggest sort of trends coming out of that. And so what do we have here? We have a squeeze early in the morning for Apple on Thursday, the 16th, right? So price was bullish into the close for Apple, so that's a clue. Price opened up relatively flat, didn't really want to push lower, pushed higher to make a new swing high to challenge the previous day's sort of later in the afternoon swing high, and then corrected, and we held above the low of the day. We held above the ending sort of last half hour of Apple's push, right? And then we started to squeeze, right? And you can go to your go to indicators. So, for example, the volume zone oscillator really is showing you that it's pulled back and consolidating around the zero line, but the action prior to that is pretty bullish. So that's an indicator. You can also go to let's go to see stochastic, right? So stochastic here, we pulled back, and actually when we're in the squeeze, we're breaking higher out of the stochastics. We crossed over the fast, crossed over the slow. So if you want to use stochastic, that's showing you again that things are bullish coming out of this squeeze. Okay. What else? Let's look at a momentum here on using my momentum indicator with their MACD. Right, here's the squeeze. Momentum's rising while we're in that squeeze, right? So that's a good sign that the price wants to go higher from that. And let's look at RSI. RSI, same thing. The RSI relative strength index is increasing. Money flow probably doing the same thing. Well, actually, money flows a little bit differently. But again, it's when we come out of that, we start moving higher. So we make a low, we get back above the zero line. So no matter how you really look at it, rate of change, same thing. We're making higher levels on the indicator as we coming out of that squeeze indicator. So that's how you can sort of predict or position yourself for when price comes out of a squeeze. Let's look back. And sometimes you don't get a move out of a squeeze. Sometimes you just get more consolidation. But let's look at this, for example. Let's look at this squeeze, right? So we have another squeeze early in the morning. What happened here? The prior day we had bearish action into the close, right? And we tried to push higher in the morning. We couldn't get above the opening range. Couldn't get above really the sort of prior resistance or support that became resistance, the sort of the pivot highs of the afternoon from the prior day, right? Pull back, but we hold support. We hold the prior pivot low from the prior day, and we bounce up, make a lower high, and all during this time we are squeezing, right? So what's the price going to do coming out of that? Well, as we go, what's happening here? We're making lower highs on the volume zone oscillator. All right, what else? What's happening in the stochastic? Well, in the stochastic, we're actually have broken lower, and we cross back below the 75% level, which I use on my stochastics, and we're trending lower, right? So that's the opposite of what we looked at earlier with the stochastics, where we actually had crossed over the facet, crossed over the slow line in the low part of the indicator. All right, and let's look at MACD. MACD again, through this last part of the indicator, we are making a lower levels of momentum. So there's no fail-safe proof method of anticipating which way price is going to break after a squeeze. And sometimes price will move a little bit up and then fail, or move a little bit down and then fail. So but what it really should be used for, and what I use it for, is to focus your attention on price. And what price may do after a squeeze has happened. And again, I like them early in the morning, and they don't go back as often. The data, when you go back, they don't show up as often on the indicator, just because of how the indicator works. But they go back for a couple days on the intraday data, for sure. Okay, so let me call up a bigger time frame chart, and we'll look at that. So hang on one sec. All right, so this is a 15-minute chart for Apple, and let's put on our Bollinger Bands, and let's put on our calendar channels. So we're looking for periods where the Bollinger Bands are inside the calendar channels. And again, the calendar channels aren't done exactly the same way as most people do it for calculation. So E-single is a little bit different, but this is a true method of how they're done. Anyway, so if you look here, you can see this time period. The Bollinger Bands are inside the calendar channels. So that's why this is identified as a squeeze, right? And my evidence for where I think this squeeze may turn out is based on a bigger chart, and I won't pull it up at you, but if you go back a few days ago, we made new highs, and we were basically creating a consolidation flag, a bullish flag here. Right, so we made new highs, we're pulling back, so you want to buy the pullback. So sometimes the pullback is quick and away you go, and sometimes they stretch. And so this one actually lasted 1, 2, 3, 4, 5 days. 5 days, and then this was Monday, the 13th of August. So we had a huge squeeze here. So again, trying to day trade during times of a 15-minute squeeze is a very tough thing to do. So that's why, just as an aside, people who just day trade stocks should really look at the bigger time frame charts, because what it's doing on a bigger time sense will affect your ability to be profitable when you're intraday trading. So if you had intraday traded Apple the last 2 days of last week, you would have had a very tough time to make money. There's probably only one person in the world who can make money in that kind of day, and he lives in Florida. So here we have the expansion, or the contraction, and what follows it: contraction, expansion. So away we go, right? Again, let's take these off just so you can see price better. You don't focus on that. So price breaks higher. So that's your clue for what may happen coming out of this contraction period, is the bigger pattern that price is making, which was a bull flag. And you don't know whether it's going to end on the first day, the second day, and this one took 4 days, which it doesn't usually do. Like if you just look at the 15-minute squeezes, they're much smaller in length, right? Say for example here. So what's happening when price comes out of this squeeze, right? Well, we made a top. We got extreme trend strength warning candles, and let's take a look at stochastics. That's probably the easiest one to understand, right? So here is a squeeze. Here we're making a high on the stochastics, and the fast indicator has crossed through the slow one, and it's crossed down below the top warning level, which I have at 75. Some people have it at 80, but I have it at 75 and 25. So coming out of this squeeze, the odds are is that price is going to go lower. You don't know that, but that's what I think you have to look for clues as to what price may do. And now after we've squeezed and squeezed and squeezed and squeezed and squeezed, these long squeezes are beautiful to find when you find them, because you get bigger moves. The longer the squeeze, the bigger and longer the expansion period after that. All right, so here we had a little move out of this contraction period right here, down to a new low, and this move here obviously was much better. So as we squeeze to the end of this contraction period, stochastics is actually at the bottom working its way higher. It's crossed through the slow indicator. It's passed back above the 25% level or 25 level on the oscillator, and Bob's your uncle and you're off to the races. So now here is another squeeze, right? So what's happened here? You've got a contraction or an extreme trend warning with the candles. So you expect some kind of consolidation pullback. Price did pull back. Did it make a bottom? It possibly made a bottom here, and now you're contracting, right? But what are the telltale signs? Well, the telltale signs is that stochastics is making a lower high, and it's below, the fastest below the slow indicator. So the odds are that the expansion that comes from this contraction is going to be to the low side. So that really works on, hopefully I showed it to you, that it works on every time frame. It works on weekly, daily, 60, 50, any time frame you want. Obviously, the bigger the time frame, the less frequent you're going to have squeezes show up. I like squeezes. I show a 5-minute squeeze on my 3-minute chart. My 3-minute chart I use because it's a little quicker to show me information for intraday trading than a 5-minute chart is. But I like the 5-minute squeeze indicator, so I've balanced those two things off, and I have a 5-minute squeeze on my 3-minute chart. It's not that complicated, and you just set the level and away you go. But on swing trading, I like focusing on squeezes on the 15-minute chart because that's where you get nice 1 to 3 day moves. Like for example here, right? You come out of this squeeze, you got a nice 2-day move. Boom, right? You made what was it, 620 to 638. So you made $18 if you're on top of this squeeze. So anyways, that's really what it is. It just measures price as it goes from the normal contraction to expansion to contraction to expansion dance that price does, and will always do. So hope that helps you guys. Talk to you soon. Bye.